of 200,000 square foot tenants as lead tenants for buildings like that. So I think the question for the guys up here, developing office is, as you look at your various projects, most of them were conceived before the meltdown. And in reality, almost all of them were conceived with these, behemoth financial services tenants. I guess the question is twofold. One, how in the hell do you finance? I know you had these guys up here in the prior panel talking about the liquidity of the market, but how do you finance these 2.5 million square foot buildings, which in reality are $2+ billion efforts? And that's true even once the platforms are built. And two, as you look at the buildings that you're building today and the nature of the tenants, there's this new acronym that we keep hearing about, TAMI, technology, media, advertising, information. How do you see the buildings changing in terms of anything that you've done from a design construction point of view to make these buildings attractive to multi-tenants, and also the different nature of tenants being an open space plan as compared to what we used to think of as some traditional office space? So, any of the office guys?
Holy smokes, you asked about 5 questions there.
Talk lottery.
Yeah. That wasn't part of the warm-up.
We got rid of the softballs, Jay.
Well, let me talk a little bit about the way in which we approach the financing, because I think it's been a really interesting transformation for us. When we, pre-recession, the whole game plan for Hudson Yards, from the latest perspective, was we were going to go out and raise a $2 billion equity fund from around the world, and that was going to be all the equity we were ever going to need for Hudson Yards. So that would build a platform and be our equity component in each and every building. And there'd be a lineup at the door for people to put money in. And we'd get our promotes and everybody would be happy. And then, of course, the whole world ground to a halt, and at that point we had to sort of husband our resources and figure out how we're going to get this thing off the ground. And I think what we concluded is that a $2 billion fund, when you're building retail, office, and residential, both rental and for sale, you automatically narrow the range of prospective investors, because most investors have preferred building type. So we abandoned the idea of the fund early on in the game and decided we would finance every single building separately. And that's been, I think, a significant change in our game plan. That then has encouraged us to go to these lead tenants and sell them equity, so in the building. So in the case of our first building, Coach owns about 40% of the building. In the case of our second building, our lead tenant owns about 50% of the building. So that's a huge chunk of equity, and they fund as we go. So they're in the draw of requests like everybody else. The second thing we've realized is that there's lots of equity, whether it's core asset or development money for condos or pension money for residential rentals. Retail, there's lots of money. So I don't think we're worried about raising the equity. And in fact, my colleague John Jacobson seems to have me making a presentation to a potential investor every single week. So basically, money from around the world is coming to New York and looking for something to invest in. And I think that's because their more traditional investment markets like London are really getting expensive. So as expensive as we think we are, you go to London and you think gosh, for a bargain. So, the equity side, I think, takes care of itself. Then we get to the debt side. That gets more complicated. And I think the regulatory environment is forcing the banks on these big mega projects they can't make, they carry a $300 million loan. So you're into club deals right off the bat, and that makes life complicated. And when we closed on the first building, we had Starwood Capital as our lender. We had the Carpenters Fund in there as a lender. We had JP Morgan as equity. We had a Solvent Fund as equity. We had Coach in as both a equity and a lender.
I assume the closing room was about the size of
and
the
I
ballroom.
mean, even John Mechanic thought it was complicated. And it was really one of the most complicated closings any of us had had to deal with. So that part is, you can, I think, find the money, but boy, it's complicated. And each closing, hopefully, will get a little simpler, but they're going to be monsters.
So down at the World Trade Center, right after 9/11, Larry Silverstein